So again, thanks for joining today's webinar. We will just start up with a few housekeeping items. I have muted the conference lines. It will remain muted for most part of the session, unless you have any questions that we would like to discuss. I'll be also posting some questions as we go along these slides, just to get some information as to where you are with your journey in terms of buying a house, and so that I can probably contextualize some of the discussions around it. So maybe why don't we maybe just start with the first poll question, and maybe let's do that. Oh, I think people join. Okay, so let's go ahead. I am launching the first question. It's a very simple question, which is asking what is your immediate real estate goal, and you have four choices that you can pick one from, or pick one of them. So I'll keep this open for a few seconds, maybe 15 to 20 seconds, and you can have a look and respond as you wish. Awesome. So I think 6 of you have responded back, 5 are buying their first home, or in fact 7 have responded, and 2 are still making up their mind. Again, this is a good spot. I'm sure you will get a lot of good information that you can use towards your home buying process. So we'll end this for now, and then let's get going. Okay. So let me just maybe start with a small disclaimer, because obviously the information that I'm sharing is for general purpose use only. It doesn't constitute legal or professional advice. You should always consult a lawyer or any other professional involved in the real estate buying process to be sure that your specific situation is being addressed appropriately. So take whatever you're getting today, use it as your knowledge to build upon and contextualize to your situation. Okay. So moving on, so we're going to discuss typically, I think at a high level, 3 major points. One is, what are some of the top 10 considerations that you should have while buying your first house? Given the current economic situation we are in, does it look like a good time to buy a house? I will talk about in general, and also I'll pose some questions that you should consider to evaluate your specific situation. And lastly, we'll also discuss about some of the new guidelines which have come around insured mortgages. In case you're not familiar about that concept, we'll talk about that as well as to what does insured mortgage mean. Before we get into this, let me give a brief overview as to who I am. Some of you on the call know me from my previous sort of profile, but just to introduce myself to everybody. My name is Neil Joseph. I am a licensed mortgage agent. I am associated with a team called the Windrose Group within the Mortgage Alliance brokerage. And we are specifically known for the educational experience and the guidance that we provide to our clients. I aspire to continue in the same tradition tonight. I am also a small-time, I would say a really small-time real estate investor in the process of sort of expanding my portfolio. So whatever I present today is based on what I have learned, practiced, and advised over the years. So I think that's in a brief about myself. Now, the top 10 considerations that we're going to discuss when buying your first home. Some of these suggestions are even good if you're looking to purchase maybe your second or third property as well. So these are basically recommendations and not really requirements. But I would say that these are some key considerations that you should have. Would anybody know, and you can maybe respond back on the chat, do you know the proportion of buyers? So if there are 100 buyers who are looking to buy their property, how many of them are usually the first time home buyers? Does anybody have any statistics around it or know about it? 80%, yeah, that's a good number, Steve. It's actually around 47. That was the figure in 2019. So roughly half of the people go through this process. And unfortunately, not knowing much about the process, they just happen to go through the process somehow and hope to come out of it without getting hurt. But the real test of it is not really how you get in, but how exactly you experience maybe a couple of years into home ownership. So if you start off with some mistakes, then these could be costly in the long run. And that is why it is important to maybe just familiarize with yourself with different concepts and what you should be careful about. Okay, so I think enough of background. Let's get into the first consideration that you should have, which is you should create a list of the various features that your house should have. Now, I'm sure all of you are aware of pizza. I love pizza. I'm sure most of you do as well. You probably are amazed with the variety of pizza and options around it. Home buying can also be a similar experience. There are a number of options that you can consider and choose from. The basic components, as well as the walls, the windows, the doors, etc., remain the same, right? Doesn't change house to house. But things like location, right? Where is it that you want your house to be? Do you like maybe living in the hustle and bustle of a city or the main street? Or maybe you prefer a quiet neighborhood. You might commute to your work, and you might even prefer to take the public transport. Maybe in normal circumstances, maybe not in today's environment, but maybe that is what you prefer. You might have kids or are about to start a family, and you probably want a neighborhood with good schools. You might probably have some extracurricular activities or hobbies like swimming, or you are a gym rat and maybe you want your own personal space in the house. You probably have a dog and maybe want to be near a dog park. So all of these are different considerations that you should have. And again, these are just few handful that I listed out. These are all considerations that you should have, and you should prepare a list of features that you want in and around your house, and then evaluate which of these are actually must-haves, right? Some of those things which you absolutely need to have, and which are probably nice to have, and maybe not. You don't care so much about. This is important because as you go through the home buying process, you'll probably realize that you need to make some compromises. Unfortunately, that is a sad reality for many of us. I myself, having gone through that journey, I do remember the number of compromises, and my wife still cribs about some of those aspects in the house we bought. So going through this exercise will help you sort of figure out what is really non-negotiable and where is it that you have some room to play around with. So do consider this because, as you know, property transactions can be very costly, and unlike Amazon, where you can probably return your goods for free, that facility doesn't happen or is not available when it comes to buying your own property. And in case if you are unsure about which neighborhood to buy, then maybe you should try renting in that neighborhood before really making up a mind to purchase in that particular neighborhood if you have doubts about it. So any questions about the point number 1 that we just talked about? Okay, awesome. So let's go on to number 2, which is now some of the features of the house that we, or the features of the house, the topic that we discussed, some of them have actually a time consideration associated with it. Some of your needs would change over time, and you probably have an inkling about what that could look like. Like maybe, for example, you might be wanting to start a family, so you probably need an extra room or a nursery. You might shift to working from home, and you might want to have a space which you can call as your home office. You might have elderly parents who probably you would want them to move in with you, and probably you would want to have a second suite. Maybe you're considering an early retirement, or maybe starting your own business venture, and you want to be free from mortgage. So all of these aspects should sort of be considered, because what happens is people sort of well, for the statistics that we have, it seems like people break out of their mortgage roughly around 33 months into their tenure. So they don't even complete a sort of 5-year period within their house. They're actually maybe breaking a mortgage, trying to buy a bigger apartment or smaller apartment, whatever the case be. But people tend to change their mind a couple of years into a property. So have some thoughts about it, because any such transaction is actually pretty costly. Okay. We'll move on to number. See, what the question is, what is the average, right? You mean the average number of years? So typically we have seen mortgages getting broken in roughly 33 months. That is the number that we have noticed. So roughly about 2.5 years, or slightly more than that. Okay. So number 3, again, it's a very small aspect of it. Again, based on the features, the time period that you want to have those features for. The choices are sort of fairly straightforward, right? You can either get an apartment, condo, townhouse, row house, semi-detached, detached family homes, legal duplexes, farmhouses, etc., etc., etc. Each of these come with their sort of pros and cons, and you should evaluate those aspects as well. Because if you buy a condo, then you're not getting a freehold property. You have a condo fees to pay, so on and so forth. So it's good to have a good realtor that you can work with to sort of decipher what works for the features that you want in your house, and sort of make that final decision around it. So we'll not spend much time on this aspect. We'll actually go to the number 4, which is again, some of those features, depending on what they are, maybe just too rare and not readily available in the market. So in that scenario, should probably want to consider buying a piece of land and having your own custom built home. Again, that's an option which is always available to you. Else, it could be that you want to buy something which is a new build property, like a builder or a developer creates it, and you want to buy in there because it has got the latest and the greatest that you're looking for. But mind that these sort of considerations have some time aspects to it. So if you buy into any of these things, they take a couple of months, if not years, to deliver. And the facilities that you would find around them are probably not there yet. So maybe if it is an upcoming neighborhood and it is yet to get developed. So again, work with the realtor just to make sure that you are arriving at a choice which is suitable for you. So I think we have sort of gone through some of the functional aspects of what your home should look like, or what are the things that you should consider. Maybe I will try and bring one more poll at this point, and just get a sense of where you are with your journey as such. So this is a poll. It's a simple question: at which stage of the home buying process you're currently at? We've got some 5 options. Have a look and maybe provide me your responses. Again, 30 seconds. Okay, I think thank you for your response. I think 4 of you said that you're just exploring, nothing formal, and 2 of you have secured or in the process of securing a mortgage pre-approval. Thank you. We'll end it here, and we'll go on to point number 5. And this is where we sort of start discussing about some of the financial aspects of it. So the first consideration obviously is there is a difference between renting your place versus owning your home. Some of the sort of the major things that comes into mind when you're renting is you're obviously just paying the monthly rent. You probably have a renter's insurance, and depending on the lease agreement that you have with the landlord or corporation, you probably are paying the hydro charges. These are typically the sort of expenses that we see, which that people have. But the expenses that you would generally have when you are owning a home is much more. You obviously have your monthly mortgage dues, the property taxes, which I stay in the city of Toronto, so it actually works out to be 6 installments in a year for me. So roughly 1% of your property value, which is paid out in 6 installments. You probably have condo fees that you have to think about if it's a condo apartment or a townhouse. You would have your hydro charges, water and utilities, gas, if you have a water heater at your place. Homeowners insurance is very necessary. Plus, you would also want to consider a budget for ongoing maintenance and upkeep. This is not a very obvious month-to-month cost, but it's something that just you need to build and keep aside in case some emergencies come up or something gets broken and you have to fix it. Another aspect which people should also consider is getting a life insurance, because obviously this is a big liability in terms of mortgage that you carry, and you need to make sure, or you should be careful about it and make sure that your dependents are not getting hassled. In case something happens to you, get disabled, there's an untimely death or whatnot, right? See, I think we have a question. How much percentage of the monthly salary should be used towards housing? Well, it's a very difficult answer to give. What lenders typically look for, and that's standard across the industry, is about 30 to 35% of your gross income could go towards your housing expenses. Again, mortgage is just one part of it, but what lenders look at is typically what your mortgage is, what are your taxes, and heating. So those are the just basic necessity expenses which are considered. Obviously, depending on the house and what kind of maintenance you have around it, how big or small the landscape is, you probably have a larger or smaller expense, right? So I would say 30% is probably the upper limit. You should try and keep it low if possible. Now, another aspect, generally speaking, is renting is supposed to be sort of costlier than owning a house if the markets were really sound, but that is not the case. Given the sort of loose monetary policies that we have seen sort of across the world in the last 10 years after the 2009 sort of crash, many cities across the world and Canadian cities like Toronto, Vancouver, Montreal, etc., have very high demand for investment properties and likes of that, and hence the prices are very high. If you use a simple measure like the rental yield, which is nothing but whatever annual rental income the land owner or the property owner gets, and if you divide it by the amount which is invested, the figure that comes out is roughly 3 to 4% on average if you consider Ontario, which is a very low sort of return, right? You probably get better returns when it comes to stock market. And so again, the figure that I'm quoting is purely based on rental. In case the property prices don't increase, then the rental income is only giving a return of 3 to 4%, which is very poor. So that is why renting is usually cheaper than buying a place in Toronto. In fact, if you don't know, it is impossible to get a cash flow positive single family home in Toronto, unless you're making like a big, large down payment, like 30% or 40% of the value if you're paying down payment. Then the rent that you get on that property could be more than what you owe in terms of mortgage or any other expense. How is everybody feeling? Is it making sense to you guys? Are you finding that I'm going too fast, or things are clear? Thank you. Let's go on to number 6, which is okay. I think we probably talked a bit about this aspect, the monthly budget for your new home. Again, as I said, the mortgage is a long-term liability, so it's a long-term commitment, and for a lot of people, it will be and remain the biggest purchase that they would make. We already talked about sort of the difference between renting and owning. So before you make the decision to buy, you should take the time to work out your personal monthly sort of budget. And we talked about a figure of roughly 30% of your gross income, which could go towards your monthly sort of mortgage. But again, the number sort of varies based on person to person. What's your like? What is the lifestyle, right? And so this is something that you should work out on your own, considering living expenses like your grocery, entertainment, travel, lifestyle, childcare, investments towards retirement, and sort of make a figure for yourself as to what is it that you're comfortable for. Because unless the budget is comfortable for you, what would happen is that you would get frustrated with owning a house. And in the worst scenario wherein you're not able to pay the mortgage, you could end up losing your house, which is obviously not a good scenario. So again, this is imperative because you don't want to change your lifestyle drastically once you buy a house and become sort of financially trapped. So you have to work out what the budget should be for your case. Okay? As I said, 30% is generally what the industry sort of looks at, make sure things are stable, but it has to be personal choice. Excellent. Yeah, I also have a certain tool that I use, Steve. I'm happy to share with you. And again, if it is if you're okay with me sharing this with others, then Steve, I'll make sure that it is sort of given out to everybody after this meeting. Thank you. Okay, so we'll talk about two big sort of outgoes that you would have with buying a house. One is the down payment. The other is closing costs, and I'll try and explain what these mean briefly. So there are a number of factors that you would have to consider when getting yourself approved for a mortgage. The first one being the down payment and how much you have. So typically for Canadian citizens and permanent residents, Hussein, I think it was for the budget, right? The 30% of the net or gross question. So 30% of your gross income, or roughly around 30 to 35% of your gross income is what we consider. CMHC is a closing cost, and I'll talk about that. Okay, so as far as the down payment is considered, Canadian citizens and permanent residents are able to get a house for as little as 5%. It changes if somebody is a non-resident. So that figure is usually higher. And the 5% sort of figure increases if the value of the property is more than 5%, because the value above 500,000, the proportionate increase over 500,000, you would have to pay 10% down. So it's close to 5% of the purchase value, but a little more. And your down payment can actually come from your own sources, meaning your savings. It could come from your RRSP if you have a good accumulation. In fact, under the home buyers plan, which is available to first-time home buyers, you could withdraw as much as $35,000 as a loan and put towards your down payment. It could be a gift from your family member, maybe even an early inheritance. You could borrow some amount against assets that you have, or it could even be a sort of a line of credit that you draw upon. And there are some other equity grants which are sort of non-refundable and available from federal, provincial, and sort of municipal agencies. But the qualification is like pretty low. It's very rare that anybody in Toronto usually gets that. So you would sort of need to figure out where is it that you want to pull this down payment out of, because depending on the amount that you're looking to purchase for, this could be a considerable amount, and it will probably take some time to accumulate this figure. So that is about the down payment. As far as the closing cost is considered, lenders typically look for a proof around 1.5% of the purchase value to be available in terms of closing cost. But in reality, I would say you should probably budget about 2% to 3% of your purchase value to be available as closing cost. And what does closing cost mean, right? What all is included in that? So one of the bigger expenses, if you have a insured mortgage, is your the tax that you pay on the insurance premium. That is one. You will have the cost that the lawyer would charge to complete the transaction, in terms of the checks to be done, your background check, your ID check, and also to complete the disbursements. So typically the lawyer's fees could be between $650 to $1,200, depending on the lawyer that you choose. You would have the Ontario land transfer tax. There is a rebate which is available to you, but still it could be a big amount. If you're buying within the city of Toronto, you would have a Toronto municipal tax as well. So all in all, the closing cost could be, as I said, 2 to 3% of the purchase value of the property. So these are two things that you would need to bring into a transaction. People generally talk about the down payment cost, but the closing cost also is there and can be a surprise if you're not planned for it. And if you don't have the closing cost, then you will not be able to close on the property or get the property in your name. So that's something that you should plan for. Steve, I think you had a question about good place to keep your down payment. So generally, we suggest that closer to 3 or 4 months before your transaction, you should have it in liquid assets. That means that money that you can pull out easily. So suggested options are typically your checking or savings account. So that because otherwise, if you move money around, the lenders typically look at they scrutinize any transactions very closely, and because they need to obviously cover against money laundering. So it's better to keep things around in one account without moving around, maybe 3 to 4 months before you want to close on a certain property. So that's what I had when it comes to down payment and closing. Any questions from anybody before we move on? Okay, so we'll go on to point number 8, and obviously there are a number of professionals who are available to be engaged as you go through this process. Let's try and identify some of the key players, right? So we obviously have a home inspector, and home inspector is a professional who would look at the property that you're looking to purchase, sort of visibly inspect the interior and the exterior of the property, and sort of give you a report in terms of what is the state of affairs, right? What is broken, what needs to be fixed, what is critically broken, and that's something that you should know before you make the decision to buy that place. So home inspector is somebody that you would rely on for that purpose. Again, the inspection is only as far as what is visibly can be seen. There would not be any sort of destructive testing or intrusive testing that will happen. This is just based on what is visible to a trained eye. The costs are typically $300 to $400, depending on who you choose as an home inspector. Now you could have another professional called the appraiser involved in case your home cannot be valued by a lender using any of the automated systems that they have, or the insurer is not able to derive or fix the value on the property. Again, the value is different from your purchase value. So the value in the eyes of the lender. Now, if they are okay with the purchase value, they would obviously lend the money against that, or they might counter you with a different value in case the prices have moved a lot in a very short duration. So appraiser is a person who sort of comes into the play, well, as a home buyer, all the costs are on you. So you have to plan for that cost. Appraiser is usually would cost you around $400. Some lenders may take up the charge, but you should work with the assumption that it is actually coming from your pocket. Anything that you are able to push onto the lender, yes, that's a positive. Then you have a real estate lawyer. You would need to engage a lawyer so that your transaction is completed. And they typically take care of exchanging the money between the lender and the seller's parties, because there are a number of parties involved. They would do a check on the property to make sure there are um, no liens or holes which anybody has, and that what you get in terms of the title is sound enough. So all those checks need to happen. They would settle some of the dues around the closing. So if the property tax have been paid extra, they would settle that with the seller and the buyer, between the seller and the buyer. So all of those things are taken care of the real estate lawyer. As I said, they charge between $650 to $5,000, depending on who you interact with. Again, these are basic lawyer fees. There could be other fees added on to that. Another profession that you should consider is insurance advisor. As I said, mortgage is a liability. It's something that you would carry on your head for a couple of years, a good 15, 20 years, if not more. So you should cover your risk or mitigate your risk as when it comes to your mortgage. And insurance advisor is somebody that I would recommend that you engage once you have got an offer sort of finalized, so that by the time you close on a property, you are covered for that liability which you are taking on. Then we have the realtor. Again, there are two realtors involved usually in a transaction. You would have a buyer's realtor, and there would be a seller's realtor. You have typically two parties so that the interests are sort of represented in a non-biased fashion. So the buyer's realtor takes care of the buyer's interest, the seller's realtor takes care of the seller's interest, and they get paid by the seller, because typically around 5% of the sale price goes to the realtor, which is usually split equally between the buyer's realtor and the seller's realtor. So you don't have to pay for it; it's the seller who pays for it. But maybe, yeah, it's sort of, you could say it is baked into the price. And lastly, I would maybe just mention about the mortgage agent. I'm not sure how many of you have heard about a mortgage agent, or what kind of services they sort of provide. So I would say maybe just mention some of the benefits of using a mortgage agent. And I'm speaking about an independent mortgage agent, because an independent mortgage agent is not tied to a lender. So meaning you're not working with a mobile banking specialist, say from Bank of Montreal or CIBC or RBC. You're working with somebody who is independent mortgage agent, who has access to a number of lenders. And what they typically do is they help you make an educated choice as to how your mortgage should be, what are the options that you should consider, and sort of advise you around it. Again, it's an advice that this qualified professional provides. The decision is finally yours in terms of which mortgage that you choose and how you structure it. The other benefit is obviously they shop around for a mortgage. So you as the home buyer need not approach each of the banks and the financial institutions who actually give a mortgage. And so your credit is not pulled multiple times. You are not walking into branches and spending your time trying to get and understand choices available. The mortgage broker would be able to do that for you. He works for you in terms of you don't pay for him. He is paid, or he or she is paid by the lender through which or at which the mortgage is closed. But it works usually on a relationship basis. So his or her interests are aligned with you as the home buyer. Another aspect to be sort of called out is that brokers or mortgage brokers generally have choices or access to lenders which are outside of your typical big six banks. And what we have seen is that the rates which are available or the options which are available are usually much better than what the big banks offer. So that is one other aspect that you should consider if you're thinking about or getting a mortgage. So I think that's what I had to say in a brief about the different professionals that you should engage. think Steve, you had a couple of questions for me, so let me have a look at it. Okay, difference between agent versus single bank. So as I said, the agent, again, the banks have a similar profile called the mortgage specialist or the mobile banking specialist, but they typically cater to only one bank. The mortgage broker would be able to sort of place your file depending on where it suits best, and they typically have access to, like, I have access to 60 lenders depending on the situation involved, because not everybody, there are selected number of A lender sort of the top profile borrowers. There are different there are borrowers of different needs. So basically, the 60 is a number that we use to place depending on the situation of the borrower. Another question I think Apurva you had is, how many pre-approval should I be getting? You should be getting only one pre-approval. You don't need to have pre-approval from different banks. As I said, the benefit of using a mortgage broker is they will look at your situation and find the lender which suits in your situation the best, and they would get a pre-approval from that lender, right? And usually when mortgage brokers get you a pre-approval, this is a much more firm pre-approval, wherein your background, your income, your documents have all been checked and verified. It is not simply a 5-minute pre-approval where the system just looks at the very basic things without actually validating any of the documentation. Steve, I think you. Okay, there are a couple of multiple questions. I'll try and run through them one by one. Steve, I think you had a question as to, are there any optional things that are in a mortgage contract, such as insurance or anything that is hidden? So when a mortgage broker closes on your or provides you with a commitment for a mortgage, he or she is sort of obliged to offer an insurance product. It's called the mortgage protection plan. But my advice to my clients has always been to get a life insurance outside of that. You obviously always have the option to decline that, and the mortgage broker would record that you have declined that thing, so you don't end up paying for any of that through your mortgage. Sain, I believe you had a question about, do you know how the first time home buyer incentive works, the CMHC program, for people looking to buy their first home? So the home buyer incentive program is a federal program. And the eligibility over here, I have not heard about anybody sort of getting the incentive or being able to get that incentive. But I'm happy to share some information. I do have an article that I can share with you after this meeting. I'll send out a sort of link to that. Okay, let's move on to the next couple of points that we have. Okay, so finding the right mortgage. We probably have discussed quite a bit about it, and I'm going to probably schedule one more webinar just to talk this aspect in detail. But obviously, there are a number of factors that you should consider to determine what is a good mortgage for you. Obviously, first of all, you need to decide whether you want to have a conventional mortgage or an insured mortgage. The difference is that with a conventional mortgage, you're typically putting down 20% of the purchase value as down payment, or 20% or more. If it is lesser than that, then what you get something called as an insured mortgage. And since your down payment is lesser than that, the lender gets the mortgage sort of insured through CMHC, Genworth, or Canada Guarantee, and they charge a mortgage insurance premium for that. So your sort of expenses increases on that part. The good part about insured mortgage is that your premium is not part of the closing cost. You get to bake it into your mortgage, but again, you end up paying for that in the long run. You also should consider whether you want the surety of a fixed payment every month, meaning a fixed rate mortgage, or are you okay sort of experiencing the volatility, again, minor volatility that comes with the variable rate mortgage. Obviously, the fixed rate mortgages come with a premium. The question is whether do you want to really pay for that, or you're okay with some minor variations. So these are things that you should consider. You should also have some idea as to whether you want to have some prepayment privileges, because depending on the lender, you could either have 10%, 15%, or 20% of your mortgage outstanding as a free sort of a limit wherein you can prepay some of your outstanding balance. Another aspect to be considered is, do you want to go with a bank or a the big six bank fixed rate mortgage? And if you end up breaking that, you are usually left with a huge penalty that you have to pay on breaking that mortgage. You have to also consider what term you want to get that mortgage for. There are terms as low as 1 year or 6 months to as long as 10 years. So depending on how long you want to keep that mortgage for or house for, you should arrive at what the term should be. You could make weekly payments, monthly payments, accelerated payments. The a lot of choices are there. You probably have an option to even take that mortgage onto a next property that you would buy in the future. So depending on the mortgage, you could get that facility. Is it something that you want to have? Is something that you need to consider. There is differences in terms of how the property is sort of registered against your title, or the mortgage is registered against your title. Some lenders use something called as a standard charge, wherein the lien is equal to your mortgage amount. There are other lenders who charge put something called as collateral charge mortgage, wherein the charge is equal to the purchase value of the property or even higher than that. Again, both have pros and cons, so you should know about how you want to go about doing that. Do you want to have borrowed funds towards down payment? So again, that's a different scheme. And also one other key aspect is, if you are intending to be an investor, a property investor in the near future after having bought your first home, then you probably want to have access to the equity that you're sort of creating, either by paying down your mortgage or the increase in the property value that you experience as time goes by. There are mortgage products out there which can give you access to that equity without you having to refinance that mortgage. So is it an option that you want to consider? So there are many options available out to you. What the right mortgage could be, what you would sort of arrive at after considering all these aspects. So the point I'm trying to make is that it is not just about going with the lowest rate that you would find in the market. The lowest rate mortgage has a certain benefit. If you pay a higher rate or a different rate, there are benefits that you get, which probably would leave you better at the end of that term. But it's something that you have to decide. A good mortgage lender or a broker will obviously discuss these aspects with you, so that you can make an educated decision about it. And again, as I said, I probably have discussed a lot about it. I am planning to have a sort of next webinar 2 weeks from now, just to go about this aspect in detail. So if you are interested, feel free to join that. I'll obviously share the event details with you later today or later this week. Okay. I think the last thing that I want to sort of briefly discuss is limiting the purchase value. So obviously, depending on your monthly budget, how much you want to pay, how much your down payment is, the purchase amount could still be having a very, very wide range. So for example, even if you consider a monthly budget of $2,500 towards your house or towards your mortgage, you could have a purchase amount range which is from $630,000 to $820,000, depending on how much of down payment you're considering, right? Again, but it is something that ultimately you should be comfortable carrying forward for the number of years that you would have a mortgage for. So go in with, my recommendation would be to go in with a value that you don't want to cross. Do not be sort of influenced by buyer frenzy that you would see in the market, or bidding wars, or just fear of missing out. I personally have gone through this process, and I know how emotionally draining the experience can be. So it's good to have somebody beside you who'd keep you grounded and not go overboard, because, as I said, purchase agreements are legally binding. Um, you make an offer, you get it firm, and people will hold you accountable for that. So I think we are sort of at the end of the 10 considerations that we should have when it comes to sort of purchasing your home. Again, these are very, very brief points. If anybody has any questions, we can obviously get into more details around it. Before we jump into the next topic, which is around CMHC guidelines, let me review a couple of questions that come up. So Steve, you had a question about open mortgages. Where can you pay any amount anytime? Yes. So there are open mortgages out there, but they come at a very or a higher interest rate. So it's a choice that you have to make whether you want to have that flexibility and pay more interest. Naresh had a question about what is the average time to secure a mortgage pre-approval. So Naresh, mortgage pre-approval doesn't take a long time. As soon as your documents are all available, it's a matter of 2 to 3 days. You can turn around with a mortgage pre-approval, or even shorter if everything is clear. Steve, how does the amortization come into play? So amortization, the term is the period over which you end up paying back the mortgage principal along with the interest. So for insured mortgages, the maximum amount of time that you have to pay back is 25 years. If you go over a conventional sort of mortgage, you have 30 years to pay back your mortgage. So typically that is how it works. Okay, got 10 more minutes, so probably we'll have to rush through some of these aspects. Hopefully it is not too much of a rush. So first thing that, or the next topic is the new CMHC guidelines. And again, CMHC is one of the insurers that you have within Canada, the other two being Genworth and Canada Guarantee. And they sort of come up with and administer programs around insured mortgages. So it could be something like new to Canada, or you could have a purchase from this improvement sort of mortgage. So they share these guidelines, and the lenders or the banks that are operating or giving the mortgages generally are sort of governed by their guidelines. Now, what has happened recently is CMHC, one of the three lenders, has gone ahead and modified some of their guidelines. There is a lot of misinformation in the media, as well as generally within realtors and buyers, about as to what the impact of this is. So I just want to quickly clarify what it means and what options we have. So CMHC has actually changed three guidelines. One, they have reduced something called as gross or total debt service ratio. So earlier you could get a benefit up to 39%, 39 to 36 to 44, 39 to 44, 39/44 percentage of your gross as towards GDS or TDS. They have cut it back to 35/42. So the impact is on your purchasing power. So if you want to get your mortgage approved through a CMHC insured program, then you are actually eligible for lesser today after 1st July than you were previously. The second sort of change that they made is they made the minimum credit score requirement of 680 for at least one borrower. Earlier it was 600. It means if you are somewhere in that range, then you would not get your loan approved to CMHC. And lastly, what they've changed is there has always been an option to borrow your 5% down from other sources to pay towards your down payment. Now CMHC has said that they are not going to accept that anymore. But the good news is the other two insurers that I talked about, Genworth and Canada Guarantee, have not adopted same or similar guidelines. So even if you are impacted by any of these 3 points, we have access to other insurers who can process your case. So that's a good news. Okay. There was a question from Apurva. Is having last year's tax documents essential to securing a mortgage? I'm a new permanent resident. I have US salary and tax records, but not Canadian tax records. There is a new to Canada program through which we could get this process. Typically, why lenders look at tax document is to make sure that you don't owe a tax to CRA. And that is pretty much what they're looking to. But if you have if you have a permanent job, you have pay stubs to prove that, then we should be able to process it. Moving on, I think this is sort of a last topic for the day. Is this a good time or a right time to buy a house? What do you guys feel? Are you looking to purchase in 2020? Steve says no. Martin says it is. Apurva says yes. Rajula says hopefully. Okay. Low supply, high demand. Steve. Okay. So let us just quickly see as to what has happened in the market since March, right? So I have just got sort of a macro picture of what is happening. So right after sort of mid-March, the employment rate shot up, went up to maybe around 13% or 14%. But since then, the month of May and June, the employment rates have actually, unemployment rates have actually climbed down. I think the total job losses were about 3 million, and a million or just over a million have gone back to work. So things seem to be improving as far as macro situation is considered. Even the commentary from Bank of Canada today was to that effect. The other three sort of charts show what has happened in the property market within Toronto. So as you can see, the inventory had come down, but now again is going up over the month of May, June, and July. So there is more supply coming out into the market, but so is the sales also increasing, right? Obviously, there is going to be more supply than sales, but again, that gap is shorter, smaller. Average prices of property sold in Toronto saw a good dip. I think it was just about a million in March or February. It came down to $900,000, and now it's again going back up, or maybe it isn't crossed that. So there are a lot of buyers out there chasing fewer properties and bidding it up. The days on market, which is again a sense of how fast properties are moving or getting sold, is low. So the gray ones are for corresponding month of June in 2019. The blue ones sort of depict what they are in the current year. So the number of days that a property is sitting in the market not sold is reducing. So it's, I would say, less than 18 days. That's not even 17 days is the highest. That's for the property between 250K to 500K. So yeah, things seem to be moving up, even though we generally seem to be in a period of abnormal times of abnormal times. So that is the macro picture. But I think the key question to ask again is, what is your personal situation, right? Are you impacted by COVID? Are you without a job? If you have a job, then unfortunately, no lender is going to give a mortgage if there is no income available. Unless, of course, you go to private lenders and of that sort. So that's a different scenario altogether. Do you think, do you believe in the logic or the prediction of a second wave? And do you think your job is going to be secure if so and such a thing does happen? That's something that you have to think, because again, it depends. It's very job specific. Not every job is at risk. Third thing is, do you have a rainy fund, right? In case some things do go wrong, do you have the financial power to just sustain yourself for a period of time? And other thing, which is sort of emerging right now, is, does your employer allow you to work remotely? Because a lot of people, again, the numbers might be lower, are considering moving out of the GTA and buying property somewhere else, because probably they can get it cheaper. They don't need to be within the GTA. They don't have to commute to work. So depending on the situation, that's something that you could possibly consider to make sure that you're getting maybe a property at a lower value. Again, it has its own negatives because it's not GTA, of course, so your facilities are going to be lesser. Is it something that you can work with? Okay, So I think I have sort of gone through all the things that I had prepared in terms of a discussion. Are there any questions that I should take? Okay. Yeah, if Steve says if I move to the suburb of Arizona, I can get a 7-bedroom for 5-car garage and basketball court and tennis court and swimming pool for under $1 million. Yeah, very true. Yeah, that is true. Thank you, Sridhar. Thanks for that. So again, in case there are no other questions, I just want to give you a sort of a view of what I offer. So I have something called as a Home Buyers Weekly. So if you want to sign up for that, maybe you can give me your email ID and I can include you in a sort of a weekly. I promise it's a weekly sort of email update. I'll share more information with you in terms of how the different things that you should be making yourself aware of when it comes to buying a house. So that's a weekly email newsletter that I have. I have something called as a 10 steps from idea to move in, which is okay, your idea of wanting to buy a house to actually you moving in. What are the numerous things involved in that? So I have a very good pictorial representation of the whole journey. It's something that I can share with you. If you're concerned about your credit sort of profile for any means, I'm not sure. Or again, in case you have that concern, you feel that you are on the edge, I can do a quick credit assessment for you and advise you in terms of what you could do to improve that situation. And again, if you are in the market for a mortgage, I am available for a free consultation. I can help and guide you. It's up to you. It's whether you want to use my services or not. But again, these are some things that I offer. These are available to you free. You can reach me at 647-904-5557 or email me at this given ID. Or in case you just want to follow me, I regularly post content on YouTube and my Facebook page. So these are my coordinates. You can find me there.
Neil, I have a question. So I would say what's a like in today's time, what is a good down payment amount like let's say a property of basically like I was looking at some properties in Barrie and then they go up to like 650 or something. Like right, and what would be a good down payment amount on? I mean, I know 20% is the standard, but is this something that could be worked with the 10% down payment?
Yeah, obviously. So as I said, right. So from a minimum standpoint, what you should have is roughly 5%. So if you're talking about 650, then it is 5% for the first 500,000. So you got 25,000, and then you need to have 10% for the excess over 500,000. So in this case, 150. So you got 15,000 more. So you could buy a property for 40,000 as down payment. Okay, which is your 25,000 to 15,000, 40,000 as down payment. But you also need to factor in closing costs. So you're about upper range 3%. So you got what, maybe around 18,000 on that. So 60,000, you should be able to go into buy a property in Barrie for that price range.
Okay, that's good to know.
Yep. The drawback with that approach is obviously you pay 4% of the purchase price as premium, the insurance premium.
Yeah, the CMHC insurance that gets in.
Yeah, so you essentially walk into a house with 1% equity.
Makes sense.
Right. It jacks up your mortgage payment a bit, but again, for 60,000 you get a house.
Yeah.
Right. Okay. Okay. If not, I thank you all for being here, spending an hour with me today. Hope you found this information to be useful. I have also recorded this session, so I should be able to send the recording to you. You could watch it or fast forward it on YouTube and watch it if you would like to revisit some of those aspects, because I did talk about a lot of things. So thanks again. And if you want to access any of these things, I have email IDs for most of you, but in case I don't have and you want to have access to these things, just drop me an email at the mentioned email ID, and I will make sure these resources are with you. So thank you again. Have a great evening, guys.